All right, let's dive into one of the most powerful and, let's be honest, most secretive forces in the global economy. We're talking about private equity.
I mean, what a question, right? It sounds like something straight out of a spy movie. But this isn't fiction. This is something that's actually happening every single day in our financial markets, mostly hidden from public view.
And that's really where we have to start. We are living through an era where the whole idea of who owns a company is being quietly but completely transformed.
Seriously, think about it for a second. Brands you know, companies you might have even followed on the stock market, one day they're there, and the next, poof, they've vanished, taken into private hands. This isn't just a small trend, you guys. It's a fundamental shift in how our economy works. So the big question is, who's doing all this buying?
Well, the engine driving this massive change is what we call the private equity machine. These are the firms operating right at the very center of this new world of ownership.
Okay, so what is a private equity firm? At its core, the business model is actually pretty straightforward. They raise gigantic sums of money from big investors, use that cash to buy companies, fix them up to make them more profitable, and then sell them off a few years later.
But here's the thing. Here's where their strategy gets so incredibly potent. To buy these huge companies, they don't just use their investors' money. Nope. They use a powerful, high-stakes financial technique that lets them control massive assets with surprisingly little of their own capital.
And that tool is called the leveraged buyout, or LBO for short. The key word here, the magic word really, is leveraged. It just means they buy a company using a tiny sliver of their own money and a whole lot of borrowed money, a ton of debt. So how does this actually work? How do they pull this off? Let's break it down. Let's look at the anatomy of a buyout. Because it's a playbook they run over and over again, and it's incredibly profitable.
It follows a pretty clear 5-step plan. First, they find a target, often a stable, maybe kind of boring, company that they think they can run better. Second, they go out and get massive loans, using the assets of the very company they're about to buy as collateral. Wild, right? Third, they complete the purchase. Fourth is where the real work happens. They restructure the business, aggressively cutting costs to make it as profitable as possible. And finally, the exit. They sell that new, leaner company for a big profit.
And this is where you can really see the leverage in action. A typical deal might be financed with as much as 90% debt. The private equity firm only has to put up 10% of the money themselves. This is how you can control a billion-dollar company with just $100 million. Now here is the absolute genius of the model. Or maybe the audacity of it. The private equity firm gets the loan, but the company they just bought, it's the one that gets saddled with all that debt. So the company itself is now responsible for paying back the loan that was used to purchase it in the first place.
So as you can imagine, this isn't just some clever financial trick. It has profound, real-world consequences that are actively reshaping the entire global economy. And the sheer scale of this industry is just mind-boggling. The amount of money controlled by private equity has grown exponentially. We're talking about trillions of dollars in assets now. It's without a doubt one of the most dominant forces in modern finance.
And when this force takes over a company, the change is almost immediate and really dramatic. A public company that was maybe focused on slow, steady growth becomes a private one obsessed with aggressive cost-cutting. A business with low debt suddenly finds itself loaded with it. The entire focus shifts away from a broad set of stakeholders, like employees and customers, to a single, intense goal: maximizing profit for the new owners and doing it fast.
And that effect ripples outward, It reshapes entire industries. Private equity is famous for driving consolidation, buying up lots of smaller, independent businesses to create one giant corporation. This forces all the competitors to get leaner too, which can affect jobs, and it can shift a whole sector's focus away from long-term projects like R&D and toward hitting those immediate profit targets.
So, when we put all these pieces together, what does it all mean? Well, it means we are witnessing the dawn of a completely new era of corporate ownership.
It all points to one crucial, powerful shift. That traditional model of companies being owned by tons of different people through the stock market, well, that's giving way to a new model, one where huge parts of our economy are controlled by a very small number of very powerful private firms.
And this leaves us with a final, really vital question. In a world where ownership is becoming more private, more hidden, and where decisions are driven by debt and the need for short-term profit, who is really in control of our economic future?